may lose some tax perks they have gotten pretty used to. This week, Democrats in Congress are looking for ways to offset more than $8 billion of tax relief for small businesses hit by the proposed rise in minimum wage. Proposals include capping the amount of compensation execs can defer until retirement and halting the deduction of fines and legal settlements from tax bills. But is Congress penalizing success again? Steve Moore is with the Wall Street Journal editorial board and senior economics reporter, and John Irons is the director of tax and budget policy with the Center for American Progress. John, we are talking about $80 million a year that the government will get as a result of these changes. Chump change. Isn't this just symbolic politics?
Well, I don't think so. I think when you look at the deferral provision that they're considering, this is really about closing a loophole, not soaking the rich so much. And I think what you can see is when the Congress has these pay-as-you-go rules in effect, they're going to be more and more looking for loophole closures wherever they can find them to try to pay for other tax cuts or other spending priorities.
Stephen, do you agree with that? Do you agree with that?
No, I think this is penalizing success. I think there's no reason that CEOs should not be able to get fair compensation and that the company shouldn't be receiving a tax deduction for that. Look, if there's a problem with excessive compensation to CEOs, then let the shareholders deal with it. I don't think the government should step in and double tax these kinds of benefits, whether it's wages or salaries or whether it's health benefits and pensions.
But, Stephen, why do you think this is happening now? I mean, CEOs have always been well compensated. Why has this become such a hot-button issue now?
Well, you know, if anyone who watched the speech that Jim Webb gave in response to President Bush's State of the Union speech last week knows that the Democrats have made class warfare a theme. That was the entire domestic theme of Jim Webb's talk about the rich getting richer and the poor getting poorer. But the truth is, if you look at CEO compensation over the course of the past 20 years, it runs a pattern. When companies do well, when the stock market is doing well, CEO salaries go up, and when the market does poorly and returns fall, so do CEO compensation. I think that's the way the system should work.
John, what do you think about that? I mean, is it all about class warfare right now?
No, it's definitely not all about class warfare. I think you referred to the Jim Webb speech. I think when you look at what he actually said, he mentioned how CEOs are getting paid quite a bit more than the typical employee. But what he did was he followed that up with a statement that we need to really look out for the broad swath of the American public. We need to keep jobs at home. We need to look at raising the minimum wage. So he wasn't talking about cutting back on CEO pay. He was really talking about making the broader political apparatus really work for average, typical people. And that's what he's all about, and that's what I think the Democrats are about these days.
Stephen, let's talk about this latest loophole, though. If you get busted and fined or you have to pay out a legal settlement, should you really be able to deduct that? It seems like you shouldn't. A fine's a fine.
Well, I think it should be deductible. And
Why?
I think, well, the most important thing is I think it should be up to the company, not to the federal government in terms of whether they want to provide that compensation. I mean, here's the one point that I think is important for the viewers. Everybody talks about excessive compensation to CEOs, and we're talking about an environment where in baseball, Barry Zito just got a $100 million contract to pitch in baseball. That's more than most CEOs are making. My point about this is let the investors who are the owners of the company decide whether these kinds of compensations are excessive.
Well, they can always sell
in some cases they are,
stock.
But in many they're not.
John,
and you know, even if you cut the compensation of the CEOs, it's not going to have any impact on the wage and salaries of the rank and file members of those companies.
John, what do you think about the athlete analogy? It's one everybody always brings up when we have this conversation.
No, I think that's right. And I think with the athlete analogy, I do think you can look at athletes and you can see how they perform. You can see if the batter is hitting the average that he should be hitting. You can see if David Beckham is scoring enough goals to earn his $250 million. With the corporate CEO, you can't always determine that. And a lot of times, as Stephen just mentioned, the stock market returns determines their salary, not how well they're doing in the boardroom. And that's the problem, which is CEOs are getting compensated for just sitting in the office, not necessarily for doing the job that they want to be doing.
You can always vote by selling your stock. We have to end it there. Thanks, gentlemen. Thanks for joining us.
Thank you.
When we return.